The smartest people on earth keep making the worst money mistakes. Doctors, lawyers, engineers, all making the same catastrophic financial errors repeatedly. They knew the risk. They invested anyway. Intelligence did not save them. Here is the thing that should genuinely disturb you about smart people and money. Intelligence and financial success are not the same thing. They never have been. Graduation does not protect you from bad money decisions. The data proves it. Smart people are not losing money despite their intelligence. They are losing because of it. The research is clear. Education level does not predict better financial outcomes. Ever. The pattern is consistent. Higher intelligence, higher confidence, higher financial mistakes. Understanding why this happens is the first step to making sure it stops. Smart people are dangerously good at one thing, justifying every bad decision they make. Behavioral economists call it motivated reasoning. Your brain wants it. Your intelligence builds the case. The brain wants something. Then intelligence constructs the most convincing argument to justify having it. Sitting in that boardroom, presenting the flawed pitch with total confidence, nobody questions the smart person. The smarter you are, the more convincing the justification, the harder the mistake is to see. Intelligence does not prevent bad decisions. It makes bad decisions sound extraordinarily reasonable. Standing at that window, watching the city, wondering why intelligence alone never builds real wealth. The research is consistent. Motivated reasoning affects smart people more severely than average earners. The justification tower gets taller, the mistake gets deeper, the intelligence makes it invisible. Here is what nobody tells smart people. Your greatest financial asset might also be your biggest liability. Overconfidence bias. The cognitive trap that hits high performers harder than almost anyone else. A brilliant surgeon walks into the stock market assuming their intelligence transfers directly. It does not. A talented engineer solves complex problems, then assumes that skill applies to building a business. It does not. Overconfident investors trade more, take more risk, and consistently underperform the simple index fund investor. Watch that trading floor. Confident professionals making rapid moves, losing to the patient passive investor every time. The executive forecast with total certainty. The market does not care about certainty. It never has. Walking through that financial district. Every building filled with overconfident smart people losing to simple systems. The research shows overconfident investors underperform passive investors by 2% every single year. 2% sounds small. Over 30 years, it compounds into hundreds of thousands of dollars lost. The most dangerous investor in the room is always the smartest one who thinks they know more. At the moment of every real financial decision, intelligence almost completely switches off. The excitement of a hot tip activates emotion before rational thought even begins to respond. Fear of missing out. A rising market. The smart investor clicks by before logic arrives. Emotion fires first, rational thought arrives second. By then, the bad decision is already made. Pride refuses to sell the losing stock because admitting the loss means admitting a mistake. Walking through that city at night. Every glowing office window holds someone making an emotional financial decision. The professor teaches behavioral finance, then goes home and makes every emotional mistake the textbook describes. Fear, greed, pride. Ancient emotional responses wearing modern business suits making modern financial decisions. Smart people dress their emotional decisions in intellectual language. That makes the decisions harder to question. Here's the brutal truth. You cannot outthink an emotion. You can only build systems around it. Active investors underperform passive index investors by 1.5 to 2% annually. Every year. 2% per year over 30 years. The math produces a gap of hundreds of thousands of dollars. Watch that trading floor. Every confident trade, every clever move, the index fund quietly wins anyway. Sitting alone at night looking at 30 years of data. The passive investor always wins the long game. Real wealth in that neighborhood was not built by being clever. It was built by being consistent. The intelligence tax. The premium smart people pay every year for believing they can beat the market. One active, one passive. Same starting point. 30 years later, their financial outcomes are unrecognizable from each other. The market is indifferent. It does not care how smart you are. It charges everyone the same price. That exponential curve, built not by intelligence but by patience, discipline, and the humility to stop interfering. Sitting on those steps, thinking about every clever move that costs more than doing absolutely nothing would have. The smartest financial move a smart person can make is to stop trying to be clever with money. Humility is not weakness. In investing, humility is the single most powerful competitive advantage you can have. Automate, diversify, stop timing the market, stop picking winners. Let the system do the work instead. The market does whatever it wants. You sit at that cafe. Your system quietly builds your future. The wealthiest long-term investors recognize the limits of their own judgment and built systems to protect against it. Left side, clever, active, losing. Right side, humble, automated, quietly winning. Same intelligence, different outcome. There is a version of your financial life that requires no cleverness at all. Just consistency and time. Years from now, that portfolio will show you what humility and patience actually produce when given enough time. Your intelligence built your career. Now let a simple discipline system build your wealth. Those are different jobs. Smarter mind, wealthier life. Sometimes the smartest thing your mind can do is get out of the way.